What's up traders, Tom here with another video. Today we will be discussing our technical analysis for indices such as S&P 500 and the NASDAQ and why NASDAQ is worthwhile looking at for traders at the moment. Our thoughts on Stanley Druckenmiller's recent statement about risk reward being the worst he has ever seen and whether we agree with that. And negative interest rates not currently on the table. What Jerome Powell told us last night and why that matters if you're a bear in the market or a bull right now. Stay tuned. So before we get started, I'd just like to remind everybody to hit that subscribe button and hit the bell if you're interested in more daily financial content to do with the markets during this crisis. And think about joining our free public Telegram group if you want to share your ideas and trading thoughts with other members of the community. So our first story is about billionaire investor Stanley Druckenmiller, and he says the stock market's risk reward is the worst he's ever seen. And he also downplays the Fed's ability to rescue the economy. Now, I always take these kind of statements with a semi-grain of salt because what they're probably trying to do, they know they have the power to slightly move people's perceptions, and together they can change the rhetoric in the market to do with bearish or bullish sentiment. So I'm sure he has some short positions out there. I'm sure that if the market comes down, he'll be reloading and doing those types of things. But look, I really like Druckenmiller in terms of his overall investments over time. He's made some amazing calls. He's got some amazing stats in terms of his returns. And I always thought he was a very astute investor, at least over his career. So pretty amazing from that standpoint. In terms of the ability for the Fed to rescue the economy, we've already seen that they've been able to absolutely prop the economy right now. But last night, we did see a change in what Jerome Powell is saying. And this is very important. So this brings me to what Powell said last night about negative interest rates. So the committee's view on negative interest rates has not changed. Very important. And that they basically do not see negative interest rates as an attractive policy choice. And the market was certainly expecting that this would have been on the cards. Remember, we mentioned in yesterday's video, I'll put the card up here, that the Reserve Bank of New Zealand did say that they were considering cutting rates in the future, if necessary, negative. And they've never said that before. And a lot of Western nations have not said that before. And all of a sudden it became this expectation that everybody had. I think that Powell realizes that what he's done to the markets is he's overinflated them a little bit too quickly. And that's why we've started to see the selling come through. And we're at critical points, which we'll be talking about later in this video technically, which if broken, we will see further downside risks. So that brings me to Brazil, which have recorded more than 11,000 cases in a single day. And this is their highest level in a 24-hour period since the breakout began. And it's important to think about this because we're starting to see potential second wave from other countries. Now, remember, we mentioned China. We're going to continue mentioning this because it's so important for investors to look at. They've just come out and said that they want to have 11 million tests done in Wuhan. So if you're doing 11 million tests there, there's obviously a thought process that is of concern. And I think a second wave still heavily affects the markets with bearish sentiment. So these are the types of things that as a trader, you need to be on top of, and you need to be on top of it from investment standpoint as well as a trading standpoint. So let's now take a look at the technicals. And the technicals of the S&P 500 are different depending on the chart that you're trading. So here we have the S&P 500, which is open during market hours. Here we have the S&P 500 futures that is open during the futures hours. And they're very similar, but slightly different. Now, if I was to put more weight on a technical analysis chart, I would always do it on the chart where the market is actually open and the biggest amount of money flow is going in and out of the market, not on the futures. So I think that's an important lesson to learn out of today's video, that if you're looking at a market and you have the choice of looking at the technicals of either, consider looking at the real open market because that's where the money flow is. So this actually is showing us what's called a double top pattern. So we've got equal highs where the resistance has been formed, at just around that 29.50 kind of zone. And then we've got an intervening trough right at the 2800 psychological zone, which has found support last night. Now, if this level breaks, it will then gravitate towards that 27.26, and it of course will try to do the fulfilling of the double top pattern. And what that double top pattern will show us is the distance from here to here will be repeated. And if we take that distance, which we'll do now, that distance effectively works out to be right into previous support. Now, we've talked about this on the channel before, and this is the idea of proofing a level using a pattern. So if a pattern is forming, and it's forming with the idea of going to the next level of support or resistance, it means that the big players are in the market and they are considering this. And that means the money flow, the gap fill, whatever you want to call it, will be more likely to occur. So the market is quite likely to come down to this level at around this 26.30. So it's interesting to look at patterns and always think about, does this pattern make sense? And did the market predict that this is where it should go? Now, on the futures market, it doesn't look like a double top so much. And I've seen a few people mention that this looks like what we call a head and shoulders. So if we zoom this out and we draw a bit of a line here in terms of a trend line, and what we can notice is that a few people have said that we've got a left shoulder, a head, and a right shoulder. And depending on how you want to look at it, yes, you could say that's a head and shoulders. But I wanted to bring up this part that's in actually our trading course, and I wanted to explain to everybody why it's better when it comes to technical analysis to never usually consider this head and shoulders as being the one that you want to trade. So the reason that is when we think about it from money flow perspective, we have a left shoulder, which is a high, then we've got a higher high, which is the head, and then we've got a low, and then we've got this lower high area here on the right shoulder. Now, technically what a head and shoulders is showing you is it's showing you an exhaustion in the market. So in a normal one, what we'll see is we'll see market do this, market reach a high, market reach something like an equal peak, and then it will come through. This is the left shoulder, this is the head, this is the right shoulder. All right, that's what we normally would be looking at. If we're looking at this particular type of head and shoulders, what is the market telling us about price action? Well, firstly, the market reached a higher high, but then it's come down and it's actually reached a higher point on the right-hand shoulder than the left-hand shoulder. And this is showing that the market is still quite strong. So it's still strong when it has a higher right shoulder. The bears were not able to push the market down. Now, if we look at this side where we've got the sloping downward version, think about it from this perspective. The bulls were here in control, bulls were in control, and then as the bulls remained and became more in control here, the bears couldn't even wait for price to make an equal high or a higher high. They pushed it straight down, and it shows that they were in control the whole time and the sentiment is in the direction. So when you're looking at breaks, you always want to consider this type of head and shoulders is much better than this type of head and shoulders. And that's because of the money flow and who is actually in control of the markets at that point in time. Now, because we've seen a double top as well on these markets, I think that there will be a fair chance of bearish sentiment, but I wanted to point that out to everybody here that this type of head and shoulders is definitely not ideal. And this type of head and shoulders is actually the best head and shoulders because the money flow is in the direction of the trend, and head and shoulders are ends of trends and starts of new trends. That's the whole point of them. So hopefully that helps everybody. Let's discuss now the NASDAQ or US 100. And I wanted to bring this chart up because this chart, whether we like it or not, is going to show now, and this is the futures, but it doesn't matter if it's the futures on this one, they look very similar. I checked before. This chart is going to show sentiment on everything to do with the US market. We know that the NASDAQ has been strong. We know that there's plenty of companies in there doing very well, but there could be a point right now where we're seeing an overvaluation on these companies. And as Druckenmiller said, the risk reward is not currently worth it as he sees it in the market. So the NASDAQ is at 9,000, a key psychological zone. And like many of these indices, it is at a key point where if it breaks under here, we are seeing a fundamental shift in money flow. We're seeing a trend line being broken, more importantly, a channel from the top and bottom side, and the market will gravitate towards the next level of support. So I would say that if this market does break, the NASDAQ has a good chance to potentially go all the way back down to at least this 8,200, 8,000 zone. And this would be where the bulls will be rebuying it. So there's a huge amount of support that will come in play at 8,000, and you will see buying pressure at this point. So if it breaks through here, it really brings on the bearish sentiment. And I think that this is one of the key charts that we'll be looking at, because the S&P 500 can do what it pleases. But at the end of the day, the NASDAQ and the companies in the NASDAQ are holding this thing together right now. So if people believe they're overvalued, and we start to see price action shorting, then the rest of the market will certainly come with it. So stay tuned and watch the NASDAQ for sure. So my final point today, and it's not a point that I think is probably not been talked about before, is things like PE ratios. Now, during financial crises, PE ratios get ridiculous because sometimes they don't make sense. So we can see over here just a standard PE ratio. It went crazy during the GFC because it looked like companies had no value at all, and PE ratios were in the hundreds and stuff for companies that had no earnings. The thing with Shiller PE though is it's based over a period of time. So it's based over the previous 10 years, and it's a pretty good indicator, but I think this indicator is getting less and less reliable in terms of when you're looking at the mean and median. When you consider the amount of money that's being pumped into the system, the Shiller PE ratio doesn't make as much sense. So if you're seeing a 26.4 right now, it might go back down to something like a 15 to a 20, but realistically, because of the money coming into the system, the old mean and median, I think that they now will be higher over the long-term average. So we might move to an 18 or maybe even a 19 or maybe even a 24 over the long term in terms of mean and median PE ratios. It has been steadily increasing since quantitative easing. So I definitely want to let everybody know that, because I think that's a thing that will happen when you're holding your long investments in the future or you're holding them right now. So we hope you found this video helpful today. If you did, make sure to hit that subscribe button and the bell. And we are looking for free website resources for the stock trading community. So if anybody has any websites that they think are amazing that should be shared, let us know in our free Telegram group, and we will share those with the community and make sure that everyone gets the best information possible for, of course, the cheapest price, being free. Thanks everybody, and have a great trading day.